Hi folks, welcome to this video on bonds. This first video on bonds is related to a premium bond. How do we know? Well, we can see here that the bond, apart from being a 5-year bond with a face value of $300,000, the market rate or the rate of similar investments at the time were yielding 4%, but our bond is paying more at 6%. So because the coupon exceeds the market rate, we know that our bond trades at a premium. So we would expect that the proceeds, the amount of cash we get when we issue the bond, is going to be more than the face value. So we can calculate those proceeds as follows. Using your calculator, we can plug in $300,000 as our future value, and again, that's the lump sum that will be paid back to the investors by the issuer in 5 years' time. That's $300,000. So we made it a plus minus to make it a negative because it's going to be an outflow from the issuer back to the investor. We calculated our PMT, which is the semi-annual amount of interest that will be paid to investors, and we calculate that by multiplying the face value times the coupon rate. And because it's a semi-annual bond, we're going to be paying 6%, which is an annual rate, every 6 months. So if this is the annual, we want it for every 6 months, so we multiply by a half, and that gives us 9,000. We know that the number of periods or the number of interest payments we're going to be making are 10 interest payments because it's a 5-year bond and the bond pays interest semi-annually. And when we know our market is 4. So if we do a compute PV, we calculate 326,948. So our entry at the issue date, which is January 1st, 2010, is going to be a debit to cash for our proceeds, a credit to the premium on the bonds, and don't forget the normal balance of a premium account is a credit because that's the side it gets bigger on, and because we're creating a premium, we're going to credit that account, and we're going to credit the bond payable for $300,000. So if we were to prepare an amortization table or a chart for the first 6 periods, which is the first 3 years of the bond, we would include here, they wanted us to include here, in addition, the carrying value at issue date, which in our issue date means we have an unamortized premium here of $26,948, which we add to our table. And we know the carrying value of the bond is what we set up as cash. That's the present value of the bond. So we know for premium bonds, the carrying value, is going to be the present value. And we know that the balance sheet amount at any point in time is the carrying value. So when we do the balance sheet, we would know at the issue date, the bond payable plus the unamortized premium is going to give us the carrying value of $326,948. To calculate the interest expense every year, we multiply the carrying value to open the first 6-month period, which ends June the 30th, 2010. We multiply the carrying value times our market rate. In this case, we know that our market rate is 4% for the year, but we would multiply this by 2%. Why? Because 2% is the market rate for half the year, and we have a semi-annual bond. So 326,948 times 2% will give us this. Now we're going to be paying out interest expense. Note with a premium bond what happens is that you pay out more than you book with interest expense. This is opposite to what a discount bond is. So here with a premium bond, we book less interest expense than we pay out interest. The difference between the interest paid and the interest expense is going to be the amount of premium that we amortize. We'll deduct the premium that we amortize in this 6-month period from the amount of unamortized premium in order to get an unamortized premium now of $24,487. When we add that to the bond payable value of $300,000, we will get our bond carried on our balance sheet at the end of June at $324,487. Now, to repeat this calculation, we would take the carrying value of the bond at this date, which opens the 6-month period that ends December 31st, 2010. So we'd multiply $324,487 times 2% to get our interest expense of $64.90. Now what we would do is we would compare $64.90 to the interest paid. The difference between the two is going to be our amortized premium. Now we had unamortized premium to open the 6-month period that ends December 31st of $24,487. So we deduct the amount of it that we amortized in this 6-month period, which is $25,10, to get $21,977. If we add the unamortized premium to the bond payable amount, we're going to get a carrying value of $321,977. So now, they've asked us here to record to use the table that you created here to record journal entries to pay interest at June 30th and December 31st, but we're in 2011. So now what we want to see is if you can read the table. So I'm going to go to make my first interest payment that they asked me to make the entry for here at June 30th, 2011. I'm going to go to the June 30th, 2011 period, and I'm going to pick up numbers from this column, or this row, I should say. That's my interest expense for the 6-month period ended June 30th, 2011. So I book my interest expense. This is the amount of premium that I've amortized. Now, when I create premium, I credit it. So when I'm amortizing or reducing premium, I debit it for $25.60. And those two amounts together are going to give me the amount of cash I paid to investors. And that's $9,000. So I can get all the numbers I need to book my interest right here. December 31st, I do the same thing. I can look here and calculate my interest payment, which is $9,000. I've already calculated my interest expense of $63.88, which again was calculated by taking the carrying value to open the 6-month period that ends December 31st, 2011, multiplying that by 2% to get $63.88. And then the difference between the payment I made in interest and the interest expense I booked on my income statement is the amortized premium, which I put into my entry here. Now, they want you to repeat the scenario, assuming now that the market rate is not 4%, but that the market rate is now 8%. Now, because the market rate exceeds the coupon, now the market's paying more than your bond is, so now we have a discount bond. So we would expect with the discount bond that the proceeds we get on the bond should be less than $300,000. How do we know that? Well, we can figure it out with our calculator. Using your Texas Instrument BA2+, we can find the face value, which we're given in the question, is $300,000, and again it's plus minus because it reflects from the issuer's perspective an amount of cash that would need to be paid back at the end of the maturity period, which is 5 years. We've already calculated our cash payment, which is based on the coupon, and that hasn't changed, so it's still $9,000. And then we have our number of payments, 10 payments. Our market rate now is 8%. Because the market rate now exceeds the coupon, we now see that our bond trades at a discount. So now we're going to record our cash received, which is the present value of the bond, at $275,667. Our discount on the bond, which discounts our normal debit balance when they increase, and again our discount's increasing because we're creating it now at the issue date, which is going to be the difference between the value of the bond's face value and the amount of the present value, which is $24,333, and we'll credit the bond payable for its face value, which is $300,000. Now when we do our table, our setup is the same as it was previously, but now you can see we set up the unamortized discount at $24,333 and the carrying value at the proceeds that we got for the discount bond. The two of these added together are going to give us the amount of the bond payable at the face value. Now to calculate interest expense every period, we take $275 and multiply it by our semi-annual market rate, which is 4%. Multiplying $275,667 by 4%, we're going to get $11,027. And again, the 4% I get because the market rate is 8%. We always calculate interest expense whether we have a discount or premium bond using the market rate. In this case, because our bond is a semi-annual bond, we're going to use the market rate at half, which is half of 8%, which is 4%. So the method we're following is similar to what we did in the premium bond. Take the carrying value of the bond to open up the 6-month period within which you're trying to calculate interest expense for, and we want to find the interest expense for the period that ends June 30th, 2010. So multiplying that carrying value here by 4%, that's going to give us $11,027. The difference between the interest payment and what we've expensed is going to be the amount of the discount we amortize. Notice here for the discount bond that the interest expense is greater than the interest that we pay. And the difference still between interest expense and interest paid, whether it's discount or premium, is still going to be the amount that we amortize. In this case, for a discount bond, that difference is $2,027, which we'll deduct from the amount that we had unamortized to open the 6-month period that ends June 30th, 2010, and that will give us $22,306. So $300,000 less $22,306 will give us our carrying value of $277,694. And onwards for our next period. For the 6-month period ended December 31st, 2010, we would see here now that we take our carrying value, multiply it by 4% to get $11,108 as our interest expense. Notice that as our carrying value increases, our interest expense is increasing. That's because your carrying value is increasing. Multiplying an increasing carrying value by a market rate that isn't changing, that's going to give us a greater amount of interest expense. Again, we'll compare that expense to what we've paid out at December 31st, and that will give us amortized discount of $2,108, which we can deduct from our unamortized discount to give us $20,199 unamortized. That unamortized discount deducted from our bond payable will give us the carrying value of the bond on the balance sheet. So now we can go through and complete the rest of the table using that same logic. The question asks us now to read our table and to give us the entries at June 30th, 2011 and December 31st, 2011. So these are the two rows that we're interested in here. You'll notice in the June 30th row, we're going to take our interest expense of $11,192 and debit that account. Credit our discount. Remember, when we set it up, we debited it. So when we reduce it or amortize it, we credit, which is $21.92. And then we're going to credit cash for the amount we've paid out. Similarly, at December 31st, we're going to do the same thing, but now our interest expense is $11,280, our interest paid is $9,000, and the difference is what we've amortized in discount, $22.80. Now, that concludes our presentation on premium and discount bonds.